Welcome to the Stock Market Palantir. Today, we are going to talk about XRX.
Xerox Holdings Corporation. It's an absolutely fascinating, if let's say stressful, case study right now. We're watching a classic legacy tech firm try to pull off this really high-stakes reinvention pivot, shifting from their traditional hardware model to become a services-led provider.
Exactly. And the whole investment narrative around XRX is, well, it's defined by the super aggressive inorganic growth. We're talking about the huge $1.5 billion Lexmark acquisition and the $400 million IT Savvy deal. They're trying to buy scale and get into these higher growth areas. But all this has created just incredible volatility. A really sharp, painful sell-off in October, and then boom, this almost inexplicable rally in late November.
And that tension right there, that is the central dilemma. Is this M&A strategy, using borrowed money to bolt on new businesses, is it a credible path to margin expansion and long-term value? Or is the core print business just declining so fast that XRX is basically just a sophisticated value trap? I think that's the question.
I hold the view that the reinvention is poised for success, provided, of course, that management executes. My bull case really rests on the synergistic cost-cutting from these mergers, and frankly, the decisive leadership changes we've just seen. The pivot is necessary, and while it's costly right now, I think the market is completely mispricing the long-term potential here.
See, I come at it from a totally different angle. The strategic intent, sure, it's clear, but the underlying operational reality, which was just so harshly exposed in the Q3 earnings, is, I believe, fundamentally unsustainable. They have significant debt, and that drastic cut to the free cash flow guidance, that is the clearest, most damaging signal of distress. It suggests they're running out of time and cash to pull this off.
Okay, so let's lay out the specifics of the bull case, starting with the portfolio itself. My core thesis is that these major acquisitions, Lexmark to consolidate the print base and IT Savvy to diversify into IT solutions, they weren't optional. They were necessary strategic levers. And the proof is right there in the numbers. The IT Solutions segment showed, 162.8% growth in Q3? That shows immediate success in moving away from just declining print hardware.
That 162% figure sounds fantastic on a press release, I'll grant you that. But I have to question the quality of that growth, which I'm sure we'll get to.
We will, but the thesis hinges just as much on execution and cost control. Management has already shown confidence by raising the synergy target from an initial $200 million to at least $300 million. That $300 million, that is the linchpin of the bull case. It's a direct, quantifiable path to margin recovery and rapid deleveraging, which we should start to see in 2026. And look at the management signal, appointing Chuck Butler, the former Lexmark CFO, a guy who managed discipline through a private equity process, to the parent company CEO role. That's essentially reverse integration of proven, disciplined talent.
That's a compelling story for the future. I see it, but I'm just not convinced by the present reality. You emphasize the growth figures, but let me give you a different perspective. That reported 28.3% top-line growth in Q3, it is, for all intents and purposes, an illusion. It's entirely inorganic. The true and frankly terrifying health of the core business is revealed by the pro forma revenue, which actually declined by 7.8% year-over-year. That tells me the secular decline is accelerating, not stabilizing.
But that decline is precisely why they bought the growth. They're performing necessary surgery here.
But can they absorb that kind of operational collapse while integrating two massive companies at the same time? The financial distress signals, they suggest no. Look at the immediate impact. The adjusted operating margin contracted to a razor-thin 3.3%. That's a 190 basis point drop. They are buying low-quality revenue at the expense of profitability. And the worst part, the most damaging evidence, was slashing the free cash flow guidance for the full year by a catastrophic 40%, from around $250 million to about $150 million. That one specific number mechanically forces a downward reevaluation of the stock. It just immediately raises serious questions about their ability to manage their debt and, sustain the dividend.
That's an essential point on margin erosion, and it leads us right into our first big disagreement, the quality of that revenue mix. I'll concede, the print segment profit collapsed by almost 38% in Q3, pushing margins there down to, yes, a very thin 3.7%. And I agree, the IT-savvy unit, while growing fast, is structurally lower margin because it's mostly IT hardware resale right now, which contributes to the consolidated margin contraction.
Exactly. It's a destructive structural trade. You have a collapsing high-margin business being replaced by a fast-growing but structurally low-margin distribution business. This is why I argue that 3.3% consolidated operating margin is not some temporary blip. It reflects a permanent shift toward less profitable revenue. And what does that mean? It means the company has almost zero operating leverage to deal with a shock. They're operating on fumes.
I would frame that margin environment differently, though. The rapid decline in print isn't a flaw in the strategy. It is the reason for the strategy. The acquisitions let Xerox immediately gain scale in higher growth areas. I agree the margin compression is real, but I see it as a predictable, temporary cost of integration, what they call the costs from Blackwell ramps, and a necessary mix shift.
Temporary is the key word the market is doubting right now.
Well, the long-term plan isn't to be a low-margin reseller forever. The strategic goal is to use IT savvy as a Trojan horse to cross-sell much higher-margin managed services and recurring contracts to that bigger customer base. That's how margins recover back above that critical 5% threshold. The pain right now is simply the cost of acquiring the customers for that future high-margin revenue.
That thesis needs flawless execution, and the margin reality really hits when we talk about the debt. Whether the contraction is temporary or not, we can't ignore how it affects their ability to service that enormous debt load, which brings us to leverage.
I fully acknowledge the debt is significantly elevated and it's a major risk. No question. However, we can't ignore how sensitive this stock is to the macro environment. XRX is extremely sensitive to interest rates. Look at that violent rally in late November. It was almost entirely driven by dovish comments from the NY Fed's John Williams. For a high-debt, deep-value stock like this, potential rate cuts are a massive tailwind.
That's a fair point on the macro side. But what about the immediate operational consequence? Management has explicitly said debt repayment is now the #1 capital allocation priority. It comes before everything: share buybacks, dividend increases, you name it.
But if rates fall, the cost of servicing that debt goes down significantly. And, just as important, the attractiveness of their dividend yield, compared to, say, treasuries, changes dramatically. The stock re-rates higher just on that improved relative yield and lower burden.
I'm sorry, I just don't buy that macro hope is enough to mitigate the operational failure we saw. That 40% cut in free cash flow severely limits their ability to deleverage from internal cash. If we stay in a higher for longer rate environment, which is still very possible, that debt load becomes a suffocating burden. If their operating margin stays at 3.3%, you start to have real risks of a dividend suspension or even a distress restructuring. The market is pricing in that debt wall for a reason.
And that binary outcome, deep value or total failure, creates the volatility we've seen, which brings us to the market microstructure.
And that high volatility is completely typical of a distressed company trying to make a massive pivot. If you look closely at the microstructure, especially the dark pool analysis, the off-exchange short volume ratio is fluctuating between 50 and 61%.
Explain why that 50% threshold matters.
Because that level indicates that large institutional hedging and selling is dominant, and these big players are deliberately executing their trades off the public exchanges, basically masking the true scale of their pessimism from retail investors. It tells me there is a deep lack of conviction in this reinvention strategy among sophisticated traders.
I see why you focus on the bearish signals, but I'd argue that same microstructure is actually the source of tremendous potential energy for a move to the upside. Look at the flip side, the high short interest. About 20% of the public float is sold short. And crucially, the days to cover metric is 6.21.
That is a critical risk for the short side, yes.
Absolutely. That ratio signals a very crowded, highly leveraged trade that's just right for a short squeeze. That's exactly what explains that violent 12% rally in November. It was a combination of good news, the new CFO, the Fed comments, hitting a technically vulnerable setup. For a speculative investor, the fundamental downside is arguably priced in, and that squeeze potential offers a highly asymmetric return profile.
But that's a trade based on technicals, not fundamentals. We have to come back to the most important question. Can the leadership team actually execute this incredibly complex strategy and get the margins back?
Yes, and they've laid out a quantitative path. Let's go back to that raised synergy target of at least $300 million. If they achieve it, that figure is substantial. To put it in context, it's more than double the company's projected 2025 free cash flow. That provides a clear, quantitative path back to a structurally higher operating margin, somewhere in that 5 to 6% range. The market right now is assigning too low a probability of success.
I'm just not convinced because the tangible evidence from Q3, the 100 basis point operating margin guide cut, it suggests the integration is already proving far more difficult and costly than even management expected. M&A is notoriously messy, synergy realization almost always lags, and it costs more to achieve than you first forecast. The market is completely justified in being skeptical until the new team can deliver tangible margin expansion in Q1 and Q2 of next year. The Kodak analogy exists for a reason. Legacy companies struggle immensely with these kinds of radical pivots.
It is a massive execution risk, I agree, but it's a risk that is already baked into the stock's current valuation.
A risk, unfortunately, that appears to be growing with every single earnings release.
So the debate really hinges on whether that robust, quantifiable $300 million synergy target and the leadership change can overcome the severe operational realities we saw in Q3, specifically that 7.8% organic revenue decline and the contracted 3.3% operating margin.
And the incredible market volatility we've seen just reflects that binary outcome. It's either a potential deep value play if the synergies materialize, or it's a structural value trap if the core business declines faster than they can cut costs.
I think we can both agree that the key metric to watch, the one that defines success or failure here, is the operating margin. Xerox is absolutely performing a high-wire act right now, trying to restructure the entire business while walking a tightrope of elevated debt.
Indeed. It is a defining moment for the company's long-term survival.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.